sunshine and 75, 80 degrees in Miami was much appreciated. And then the hotel we were at, Spencer, was one of the nicest ones that I think we've been to in regards to the conference center. 39th floor, big floor to ceiling windows, great
cool.
great vantage point. If you're going to spend all day in a hotel in Miami, that was a good one to be in. But really had a good time to enjoy walking around, navigating the. This might be me.
Okay.
Correct. I apologize. That's me.
Yeah, all good.
I'm sitting here watching as well. Just want to make sure we're looking okay.
Keep talking about the hotel.
Walking around, shaking hands, meeting allocators, meeting other sponsors,
Yeah.
other managers. The conversations are always positive, even if it's not an immediate direct connection in regards to raising capital for Midwest multifamily.
Yeah.
There's always some kind of educational component for me because there's so many different asset classes, risk profiles
Yeah.
of wealth managers, anybody that's looking to allocate funds. They're always involved in something different. Like you said, it's a cast of characters. You really never know who you're going to meet or what kind of conversation you're going to have.
Yeah, and all over the international investors also. There was a lot of folks from Latin America, Central America, South America, folks from Europe. Yeah, like you said, those different perspectives doing some similar things, but then also very, very different at the same time, and just so really fascinating to see. Well, we're going to get into all that in more about capital raising, what's it like at these conferences. But first, let's jump into our latest research report. It's authored by our data analyst, John Chapman. Griffin put this together as well. My name's on it, but really those two guys put this thing together. An incredible amount of research, our own proprietary machine learning models. We're able to forecast rent growth, what it's going to look like in 2026, as well as vacancy and starts. Wanted to highlight one market. We highlighted Columbus last week. We're highlighting Chicago this week, which Chicago is not a market that Gray Capital we typically are actively targeting for. It's not one of the most landlord-friendly markets. Illinois isn't the most landlord-friendly state. There's a lot of political considerations, whether that's potential rent control, but also property tax liabilities, especially in Cook County. Some of the suburbs are much more attractive, but in our opinion from the beginning, there have just been markets with a little bit less risk and that appear as attractive, if not more attractive than Chicago or other markets in Illinois. So it's like, let's keep focusing, for us, at least for us, markets like Indianapolis, maybe a Fort Wayne, Columbus, Ohio, that are even closer to us and are more exciting than Chicago. But that being said, we're not the only ones that haven't been investing in Chicago. And the reality is that people haven't been building as much in Chicago. And so the fundamentals are really strong for a supply and demand perspective. And in our report, Chicago is projected to receive the highest rent growth of the markets that we analyzed in 2026, and it has been experiencing some of the strongest rent growth in the country, especially for a major metro. I think the only metro right now that is really beating it in year-over-year rent growth is San Francisco, but San Francisco had years of deep negative rent growth, where Chicago has been much more stable and has been compounding this growth. You have any thoughts on Chicago? I mean, it's close to Indianapolis, from the quality of the city, but also from a multifamily investment perspective. Curious your thoughts, Griffin.
Right. I think it's interesting. You see the positive rent growth story here. Really the leading driver in Midwest rent growth currently is Chicago, but as you mentioned previously, the barriers to entry relative to the state of Illinois, the city of Chicago, and its market. Are you willing to go through and kind of fight through some of that red tape, jump through the hoops, incur some of the legislative policies in regards to being a landlord property owner in order to kind of chase this positive rent growth story currently? There's obviously pockets and markets and counties upon which we're most interested, but it's quite interesting to see Chicago kind of surface in the back half of 25 as the leading market for rent growth in the Midwest. We love to go to Chicago. It offers a lot of to Midwesterners, a lot of this big city feel, the opportunity to go downtown, grab a nice dinner. The walkability of downtown is amazing. But in talking to a lot of my friends that live or are from Chicago, there seems to be a lot of interest in some of the suburban markets instead of the urban core. And so this 2% projected rent growth in 2026, while this is titled Chicago, Illinois, this rent growth projection does include, essentially the MSA, and so a lot of these suburban markets of Chicago, even into the state of Indiana. into the the Decatur, or not Decatur, the Munster, Crown Point markets, to where
Yeah.
I think there could be a lot of growth a little bit closer to Indianapolis and the great capital headquarters to get into and reap the benefits of the Chicago market.
That's a really good point. I'm glad you brought that up, and that is really kind of what we're more interested in. It's not necessarily on the Illinois side of the border, but some of the growth is spilled over on the Indiana side of the border, and kind of the region, as they call it.
The region.
And I don't know if I want to get into too much more details. I don't want to give away some of our true targets, but there are some markets up there in the region that are really attractive because from a whether it's an income tax perspective, just political perspective, or just quality of life, there are folks that are moving over to Indiana, and so we're seeing a lot of growth from the retail, jobs, and just population,
Right.
just right in that northwest region of Indiana, a way to take advantage of some of the growth in Chicago without taking some of the maybe political or tax risk that might be present. Yeah.
Just taking a look at the starts for Chicago, just quickly, as you see, we're predicting a 10% year-over-year variance or increase from 2025 and 2026. Maybe these 7,500 units that get delivered, that might be late 27, early 28, maybe even late 28.
Yeah.
It's only 7,000 units in what is quite a large city. 7,000 units is quite a bit. What do you think this does? And I'm not asking you to project into 27 to 28, but this 2% rent growth in 26, based on the starts we're projecting, where do you think the rent growth story goes from here in Chicago?
I think it remains, relatively stable, and I think they're going to see some growth. I mean, even though the starts are picking up, again, their starts were relatively muted in the last couple of years. They
Right.
didn't experience just that huge surge like most other markets in the country did see. So I think rent growth is going to stay pretty stable. I think it's going to grow, as the rest of the nation grows, most likely in 2027. And just as a reminder on the report, one of the big takeaways is there's not the evidence and data to show that there's going to be robust rent growth. We think that's going to lead to some really interesting buying opportunities. So we think that the rent growth is probably going to occur, in 2027. That all being said, I could paint a variety of scenarios where we see rent growth stronger than this, not just in Chicago but other markets in 2026. So a lot of the weak and we've really experienced some of the softest rental market I've really seen probably in a decade or so. This last 6 months. I mean, it's been slow. But so much of this, the two factors we talk about this a lot: are new supply and sentiment. Supply is moderating. We're going to talk about in the apartments.com list that I don't think it may be as dramatic as some people want it to be. It's not going to be all of a sudden there's no more new supply and everything's tightened up. It's going to be a gradual, slow burn. There's going to be concessions. There's going to be slow growth. There's just more competition in the market. But outside of that factor, the other pieces that, are really a dice roll. That people are going to be getting bigger tax refunds in 2026. That's exciting. What that impact is, it should be positive to rent growth, because I think it could be a little bit inflationary, but we'll see. Maybe people pay down their credit cards. They don't go and rent something. And just some of these other kind of policy decisions, whether it's deregulation, et cetera, does that really impact the economy in a positive way? I think it's a question mark. Some people think it will. Some people may think that it won't be noticeable. Tariffs, another factor. More consistency in tariffs come off. You can paint again a variety of a number of dominoes fall. You could see a chain reaction where we could see some really strong growth. I could paint a variety of pictures of where we don't see that growth, or things get really bad, and then you could even go to the extreme of even getting into a recession if the employment picture really the deterioration accelerates. Which we had a relatively weak jobs report this week, but it's not necessarily like the roof's falling off.
Yeah.
It's not great, but it's not absolutely the worst. So, but I mean, 2% average rent growth, again, historically, for any market that's a little weak, it's going to be below inflation. But when we're forecasting at the national level, 0.85% annual rent growth, you're more than doubling what that national average. So
Correct. And shaving almost 200, if not more, basis points off of the vacancy.
good point.
So there's obviously the suppliers remains low in regard to the cross section of demand, and so that's where you're getting that rent growth.
Yeah.
So yeah, Chicago it seems exciting for us across the next 12 calendar months.
Yeah.
It'd be fun to have those conversations with Addison and Jay in the acquisitions desk and see if there's anything that begins to pencil a little bit better for us in the Chicago market.
Yeah, we'll see. Stay tuned. And just as a reminder, December 16th, we're going to be doing that live webinar. We're going through every single Midwest market, getting into some of our strategies, just how we see 2026 unfolding. December 16th, be a lot of fun. I think it's 2 p.m. John Chapman's going to be here. It'll be a great time. I want to go through this apartment list. They call it a white paper. I guess technically this is a white paper. It's an interesting piece that's perfect for this podcast and YouTube show. What's ahead for multifamily? 11 trends to watch in 2026. A lot of these things we've talked about, but not everything. A lot of this is kind of market-based. Some of this is operational-based, which we like talking about both. We've hinted about this topic today already, but number one, their takeaways for 2026 is the supply pipeline will see a dramatic slowdown. Saying after a record high wave of new supply in recent years, the construction pipeline will drop significantly in 2026. It's saying that it's dropped already 30% by the end of 2025. And permits are also on the decline, with construction starts having fallen 71% from a peak of 21,000 units in Q1 2022 to just over 60,000 units in Q3 2025. They do have this fancy chart here showing down, again, these starts coming down on a quarterly basis to only 60,000 units. Again, off from the peak of 200,000 units in 2022. We've talked about supply is going to be reducing for a long time. I mean, probably the last year or so, and that is true. But the more we've done research, our research, and the way that I guess we've seen it unfold, is that, and I think this is also the mistake. It's not even a mistake, but similar to the analysis on expiring loan maturities, that we did a lot of analysis and research on as well. And while I think that we were pretty transparent that it's going to be a large window of max pressure, what it looked like in the perception that it created is that there's going to be an inflection point. So everyone is looking for like the moment that the market shifts.
Exactly. Yeah, you can't really, not clickbait, but it's definitely a better headline if you can pinpoint a certain month, a certain quarter where, hey, this is the trough, this is the bottom. Supply is dropping off that proverbial cliff that we talked about this weekend. That cliff might not be a cliff. Maybe it's just a constant gradual, downhill until we get to the plains.
Exactly.
Yeah.
It's just not, cliff is like literally it drops to zero all the way to the floor, and that's just not going to happen. And even this chart makes it look like it's going to like zero, which is just not the case. I mean, if you look at we go back to even our analysis. We're forecasting that starts are actually increase 7% from 2025. No, those are starts, aren't necessary deliveries. So that's a little bit of a discrepancy from the apartments.com, which is using CoStar figures. And this is obviously on a quarterly basis, and this is just at the end of 2025. But we're still going to be delivering essentially at 2019 delivery levels, which was at a peak at the time. And so it's a base effect and a relevancy of, it's off the peak of 2022, but we're basically back to 2019 levels. We're still adding a lot of new supply. Maybe it would be a very healthy amount of supply if we hadn't just delivered more apartments than we ever had over the last couple of years. But what we're getting at is, for owners and investors who are anticipating immediate relief, don't get your hopes up.
Yes. It's great to see, a curtailing of supply. Obviously, it improves our fundamentals for, what we're talking about in our forecast is really the rent growth. There was an article that we included in the newsletter this week that was discussing the relative affordability for the median home in the United States. It took the least affordable markets, and then it took the most affordable markets. A lot of the markets that we operate in were in that most affordable markets category, and specifically, just out of personal interest, I had a heightened focus in Indianapolis. In 2020, there was almost 75 to 80% of the median, the homes could afford a median average household. Today in 2025, it actually dropped below 50%, and that's in one of the most affordable markets in the United States. Half of our families, half of our households can actually afford to own a home. So supply is going down, and less people can actually afford to own it. You would like to think that the demand for rental housing relative to the supply will continually lead to, in our forward-looking years, 26, 27, 28, and beyond, positive for folks like Gray Capital,
Yeah.
And folks that want to invest in rental housing.
Yeah, I think it's a good point. And I mean, what was the statistics that we were looking at earlier? I mean, it's a $1,200 difference between
Right,
renting.
the spread.
Yeah, the spread between renting and owning. That's just your mortgage payment versus your rent payment. Obviously, doesn't include the down payment and the rest of it. All the capex, and if you're gonna fix up your house, it's really expensive. No, it doesn't seem like that trend is reversing anytime soon. It doesn't look like there's a fallout in the housing market, at least just yet. We'll see if all the baby boomers decide to sell their houses all at the same time or not.
Right.
Not exactly counting on that either. Which markets will see the greatest decline in deliveries? This is back to the apartments.com report. Looks like Orlando, Florida is going to see quite a bit. Then Salt Lake City is going to be down. Austin, Texas down by 3%. Raleigh, Columbus, Ohio, Charlotte, Nashville, San Antonio, Phoenix, Denver, all markets need it. They need to see. Now, they have continued to deliver in a lot of these markets also. And frankly, they would probably need to see greater declines to really get back to positive growth. Austin, Texas has had negative rent growth for quite some time. Denver, Colorado has the most negative rent growth in the country of any major metros right now. All right, number two, we can talk about this. Rent growth will slowly begin to accelerate again. They've tried to make this seem as positive as possible, and maybe so have we.
Right.
But this isn't really, too hot of a take,
No.
in terms of it's pretty tepid, if I have to be honest, because it's gonna begin. But it's going to accelerate slowly. It's not necessarily going to grow a lot, but it's going to start to be positive slowly. How long? They're not sure, but they are saying in 2026 rent growth will finally begin to accelerate nationwide, but the increase will be gradual.
I hate to be nitpicky there, but what are your thoughts on the word usage or the choice for plateau? So how long did the plateau last? I think the last few weeks of the Gray Report we've talked about national rent going negative, and so it's actually beginning to have that down and to the right. So plateau for me would make it seem like rent growth is going to be relatively flat. And our projections, there is some slow growth, but it is relatively flat. And so it would just, for me, I don't mind the word plateau, but it just insinuates that rent growth will be flat across 26 is what they're insinuating.
I mean, well, the one credit to the plateau statement, because typically there's volatility, seasonality on rent growth. We don't have the apartment list piece here today, but if you looked at that, obviously there's usually a peak in kind of the spring and the summer. But as we talked about in previous episodes, that kind of seasonality chart has been flattening. And there's a little bit more growth earlier in the spring and a little bit more growth in the fourth quarter than we have seen in previous years. All this kind of brought on by the pandemic, shifting things around. I also think some dynamic pricing and being able to choose longer, shorter lease terms in more communities is probably impacting this. But we're seeing just a flatter curve of more consistent rent growth throughout the year. There are still peak months. This year moved a little earlier. It was more in March than it was in April and May, and so I don't know. Maybe it's not too inappropriate. They are projecting double what we're projecting, essentially for 2026, and maybe that's right. They have a kind of a kick up at the end of the year, and I think that's absolutely plausible. I think it could kick up to 3%. Again, if the things that we talked about earlier, consumers' sentiment. Tax refunds are really popular. If if something happens with tariffs, we don't get into a couple wars. I don't know.
Right.
People could start moving things around and get excited, get the housing market moving again. Certainly, it's possible, but they do seem to be a little bit more optimistic, or seeing. Yeah, there's a little maybe more optimistic than we are, or maybe we're also. I think that we've been anticipating return to growth for the last couple of years. A lot of this is revolve around like interest rates. If, okay, interest rates are going to come down, transactions are going to pick up, and then, I thought it was going to be 24, I thought it was going to be in 2025. And now I think, and so maybe we're going to, it's almost like I'm hoping that we're wrong.
Yeah.
It's like no growth. Market's going to be horrible next year. Prove me wrong.
Prove me wrong. We'd love to be wrong in that event.
Yeah. And it's, I'm just looking at the data, just being straight up. But then also it's like, well, we thought it was going to be all better this year, a year ago, and so maybe we can do the inverse, will into existence by saying it's not going to happen.
Right. I think the ultimate key here is just being patient, sticking to your guns.
Yeah.
As somebody that's looking to invest and or acquire.
Yeah. Patience is key, and again, I think it's overall very healthy for the market. And if you're a long-term investor, this is all really good because there are going to be better entry points versus a scenario where things kind of kick back on and there was a lot of growth all of a sudden. There would be a rush in and then could create another bubble potentially. This we're hoping for. That it creates an opportunity for some seller capitulation. Like, we got to sell at a price where the market is, just because we don't have the time to wait another year to sell, because everyone's been saying, well, let's wait for the market to get a little bit better.
Yeah.
Let's wait to get a better trailing 12 financial statement to bring it to the broker. At some point they're going to tap, cry uncle, and they're going to say, let's just sell the thing. Just let me give you my money back. Let's redeploy it. And if you have a 2-year horizon, 3-year horizon, I think you're rolling the dice. It could pop off and make a ton of money. High risk equals high returns, but high returns equals a lot of risk also.
Yeah.
Go to zero. But if you have a long-term perspective, I think 5 years or longer, I think you find yourself in the sweet spot. But it doesn't have to take 2 years or 3 years. It can be 4 or 5 years, but you'll have a strong basis and you'll be able to capture that growth. If you're not owning in the period of growth, if you're buying when things are growing like people were in 2022, maybe that there's typically, these are long cycles, and again, it may not be the worst thing, but you're not going to make the most money. You're not going to get the most alpha in the market if you wait until the writing is all on the wall, because there is so much pent up capital that loves multifamily, just trying to make sense of the fundamentals. And so by just having that longer term perspective, being conservative, doing deals that work with, conservative assumptions, realistic assumptions, but conservative, you're not going to get burned and say all right, maybe this, I'm not super excited. This is just a 15 IRR, and maybe I could get more. I got more in the stock market last year, but maybe the stock market doesn't perform that well next year, and 15's not that bad. Maybe even 14, and then, well, maybe we don't sell it at a 6 cap like we're putting in our underwriting model right now. Maybe it does sell for a 5.5. Maybe things go back down to a 5 cap because AI brings in all this deflationary pressure and interest rates come down. Again, you can't underwrite that.
No.
But it's also not improbable.
You can't underwrite it. Maybe it just gets a little bit more speculative.
It does get a little bit speculative.
Maybe you shouldn't underwrite it like that.
It's cherry. That's why it's the cherry on top.
Yeah.
It's like you don't need the cherry. You don't even need the whipped cream. But if it happens, that's great.
This is interesting here that they've got the regional up close in regards to the markets. Chicago is on there right at that 3.4%. Again, they're a little bit more optimistic than our forecast, but look just right underneath Chicago.
Yeah, indeed. Yeah, they got it 3.2. I mean, we're about 1% on our forecast. So they're certainly a little bit more optimistic in all of their projections. Again, they've got Denver at 2.8. I think that's a tall order. Some of this, again, apartments.com, we talk about this sometimes. Who is apartments.com's customers? Who are they selling to? They're selling to us. They're selling to apartment owners. Like, sure, they want you to rent an apartment, but that's not what this publication is for. This is for apartment owners, property managers, and they don't want them to be depressed because they want them to spend money on marketing through apartments.com. And so they're saying, don't give up hope. We want to fuel you with a little bit of optimism. I'm not trying to be too conspiracy theorists, but they have the industry in general doesn't love bad news. Now, there's sometimes where the data is where the data is, and you can't hide from it. But just having done our own research and our own models, this looks like the weights were kind of turned and pushed towards more of the growth perspective.
Right.
Which again, there's factors that could lead to that. It's just you have to speculate a little bit more and really be optimistic.
I don't mind this forward looking approach. We did our 2026 forecast, but I don't think that just looking out of your windshield does a whole lot of good if you don't have a rear view mirror and can kind of see where
Yeah.
you've come from. Indianapolis year over year in 2025 we were positive, but Denver, to me that's a negative rent growth story in the last year, and so you're a positive 2.8% rent growth in 26, but you're coming from a negative year over year.
Yeah, I think they're like -8 right now.
And so then you want to take those 2 years, 25 and 26, put them together. What's
Yeah.
the rent growth story there? You want to add in 24 and continue to kind of stack those years. And I love that Indianapolis is up here on their list because again in the Midwest we've seen a deceleration in our rent growth, but we remain positive year over year. So just like we talk about compounding returns, we're compounding rent growth year over year to really drive NOI to then on the back end increase asset values.
No, it's a good point. It's that compounding growth and the consistent growth. Yeah, San Francisco 4.2%, but again, I don't even know if they're back to 2019 levels.
Exactly. Yeah. So I guess if you just can't see the past year's performance, is it really 4.2% growth? I mean, you're within the 12-month calendar. Sure, absolutely. That's a positive news story, just like you're saying, that they want you to hold on to that optimism. But without better understanding what the last 2 years, or the last 3 years, 5 years have looked like, you really can't get the full picture just from 1 year's data.
Yeah, really good point. Number 3, leasing and operations teams embrace automation, talk about unmanned communities, AI chatbots, self-guided tours, digital package lockers, self-service resident move-ins, and smart tech to reduce usage and detect leaks. This has been, I'd say, a trend before COVID, and then obviously COVID accelerated a lot of this, especially the self-guided tours. The AI chatbots have been around, but obviously AI is a much bigger story, and the AI chatbots that we're using today are just a whole different league than they were a couple of years ago. But I think it's getting to the point of where a lot of apartment operators, especially at higher end luxury communities, A-class assets, you kind of need some of this stuff. The one I think is controversial, and I can tell you what we think about, is the unmanned communities.
Yeah.
What do you think about it?
Well, so we were just down in Miami, and we're seeing all of these unmanned, whether it's vehicles, delivery, components. I think that and maybe it's because I'm a product of the Midwest, and
you see some of those clankers running around.
Yeah, I appreciate the interaction with a human being. Everybody does customer service, but not a lot of people do hospitality.
Yeah.
So I think at a gray residential, a gray capital property, there's some value in having the hospitality component where there's a friendly face coming, to your door to handle your maintenance request, outside of having this kind of vacant, empty space where, you're ordering or establishing anything that you need, request communications on a tablet, a platform. You go to any restaurant these days and you want to order on the screen. I'd way rather interact with a human being, personally, than send it through this unmanned property. But I do appreciate what it can do to overall expenses and in regards to cutting expenses and generating revenue on the back end. But I think one of the things that we're doing, and we've talked about previously, in regards to the centralization of our leasing and property management, just behind us here in the next room, we do still provide that human being touch, the hospitality component, to our leasing. While there may not be anybody always in the leasing office at our properties, several hours a week, certain days of the week, we do have folks that are there. But in the event that you need to call and talk to a human being, you can call, and you're always going to get Bronte, Brittany, anybody on the phone. And with our portfolio so close, we can send our leasing staff to the property. And so the vacant leasing office or the vacant community clubhouse, to me, kind of leaves somewhat of a bad taste in my mouth, but I do appreciate what it can do for bottom line revenue at a single asset or a portfolio.
Yeah. I mean, you go to like a self-storage facility, and there's rarely anyone that's actually working at the self-storage facility.
Right.
I mean, there's right now, most semi-modern ones have a kiosk. You can go in, you can rent something just right there, basically like a vending machine. And all that technology exists to do just about the same thing for apartments. And where I think it's important is meeting the resident, the customer where they are, and that people have different preferences. There are some folks who might be Gen Z, it might be regardless of the generation, they might really like the idea of not talking to anybody and doing it all on their phone and doing a self-guided tour and moving themselves in. They don't have to talk to anybody, and that's, it's their prerogative. A lot of other people, though, I want to look somebody in the eye who's going to be around here.
Yeah, and that's my personality type.
Yeah.
I
A lot of
would way
people are like
rather
that.
interact and engage, be able to ask questions in real time and get, authentic human being answers. You ever jump in an Uber and you check the box, not interested in having conversation?
I never check that box, even though I want to sometimes, because I
always feel bad if I ever do it.
I'm the same. You and I are alike in that way.
Because that person, maybe they want to talk.
Sometimes I do want. I would really wish I had checked the box though.
Right, correct. But then I've got buddies that live in markets where the Waymo is a big thing, similar to the self-storage facility that you were just talking about. If you're somebody that really has that preference of, I'm really not interested in having that human to human contact, there's options for that.
Yeah.
And I do think that we can provide a kind of a bifurcated solution and offering up, both avenues. And at the end of the day, there's an opportunity to, pair up software that allows folks to come through and really not have that human engagement. But if the event there's somebody that does, we also have that optionality as well. And I think you can cut costs and provide a benefit to the asset, a benefit to our investors and your residents by offering them the optionality and kind of that all-inclusive package. I personally do not agree with walking into an empty leasing office and having it be fully automated.
Yeah, I totally agree. And that's why we're moving to having still folks in the leasing office, still having, a manned, leasing, or community clubhouse, our maintenance facilities team are going to be on site. Maybe we don't have, large team of, leasing consultants on site. Maybe there's one, so the property manager, because there's going to be tours. We want to be able to guide you around if you want to come in and take a physical tour with someone.
Right.
Now, there's also opportunities where we might just be able to dispatch, somebody to give that tour that's scheduled. But what we believe is going to be a competitive advantage is being able to provide that human experience when no one else can provide that human experience. I think at some point there's going to be a little bit of a snapback and desire for human connection from some people, maybe not everybody. But what we've tried to do is look at what needs to be done on site, or what should be, what makes a really unique experience. But then what are the tasks that really don't need to be done on site? In fact, it's a distraction from the core responsibilities of being on site. Like a lot of administrative tasks. You don't have to do it there. The only reason to be on site is to make sure that the asset is secure. Kind of risk management. Keeping an eye on it. I mean, you think about, we've got 60, 70, 80, $100 million assets. The idea of not having anybody there to watch it. Right. Is a little asinine.
It's a little bit unsettling.
Yeah, it's I mean, I couldn't talk to our investor. Do you have anybody at your company even, watching the asset? I mean, that would never happen because at a property that size, we have to have maintenance personnel on site every single day doing work orders, doing turns, and all of that. But who's running the ship? There's got to be a captain driving the ship.
Right. I heard you mention this yesterday in discussion with an allocator in regards to identifying the daily responsibility of the site staff.
Yeah.
Maybe identifying that there are individuals that would otherwise work behind a desk in the leasing office, giving tours, running administrative duties, executing leases that we could bring here on site at Great Capital headquarters, removing an individual or two from our leasing offices, but then it also opens up an avenue or a window to bolster our maintenance staff. And so that way, if and when we do have a rush of maintenance requests, we're able to satisfy those requests in a timely fashion. We just have a higher capacity there. And in today's leasing environment, renewals are imperative to retain residents. Obviously, it's reducing turn costs, but we're also seeing a little bit larger rent growth on those renewals. So ensuring that those maintenance requests are taken care of in a timely fashion with a high level of not only customer service, but hospitality, resident retention goes up. So maybe that, you're solving two issues really at one time by reorchestrating and repositioning that site staff, one here on the corporate office, and then adding, a maintenance supervisor or a maintenance technician at each site.
Yeah. No, I'm all about it. And it's hard to do because it's hard to find the maintenance facilities the folks that are really good to hire, but we want
Right.
to I'd rather overhire in that area of the business. So one is protecting the asset. We're doing effective risk management, but also we're delivering the best resident experience, and we're not letting anything go and not getting the work orders on time. Because again, that's the reason why people decide to move. It's the number one reason.
Right.
Late work order, don't like it. We do have a comment. You can ask us comments in the chat, which is awesome. We'll get back to you. User Womp Womp 196 asks, human interaction is very important to the average consumer. I see reports talking about adding AI powered leasing agents, and I don't think that people would prefer that over a real human. Yeah, we tend to agree. I think some people don't like dealing with people. I get it, and I think that if the technology like does what you want it to do, there are cases where it's like, this is great, this is easy, schedule something for me real quick, let's get it done. But there's going to be a lot of cases where I just want to look to you face to face and talk to a real person.
Right.
All right.
I think too, when you in our specific example here, the folks that we have that are answering the phones in our corporate centralized property management and leasing, they're well trained, they're patient, they're well spoken. So when you get on a phone call like that, and even if your problem is minuscule in your life, or maybe it's a big deal, when you talk to someone on the phone that has all of these professional and personal traits that are positive, like Bronte and Brittany and the team we have here at Gray Residential, that customer experience is so far accelerated to just having that chatbot or that automated system of hit one, hit two to get where you need to go.
Yeah.
It elevates that resident experience. So if there even is a thought of moving, it's like, hey, no, Gray Residential, they do a great job.
Yeah.
And if there's any problem, please call.
Yeah.
Because you're going to get this friendly voice on the end of the phone that is solution oriented.
Yeah, what we're really using, AI chatbots or like virtual like receptionists. It's a part of like a layered system to be able to. It's kind of like a last line of defense, at least for us. It's not our front line. So like our front line is if you call us, we want you to get our absolute best, most effective salesperson. We call them more. It's really selling. Not we're just going to lease you. We're not going to take an order from you, but our really highly trained leasing professionals. You're going to get our best person that's available, but they're not always available. We don't have a massive centralized leasing team.
Right.
We'll continue to grow it as necessary as we scale. But we also might be out of hours. We're not having folks work 24 hours a day. So like the second line of defense is we have a virtual assistant that's overseas. And this is for a lot of off hours, times that we're not going to be working, but someone that is trained, knows our properties. It's the same. They're essentially they're on our team.
Yeah.
You'll get to them next. But then whether it's in the daytime and our in Indianapolis corporate team isn't available to take the call, or if it's off hours, folks are busy, huge amount of volume, that's when the AI comes in. And you don't get to a voicemail. You still get to something that can effectively get you what you want.
Correct.
And maybe that is scheduling a call with a real person.
Right.
That's an option.
It's going to be really interesting as we get to number 4 here. AI-powered leasing will take off.
Yeah, well, and that's kind of what we've been talking about, right? Yeah, there's so much. Here's what there's so much opportunities for marketing and leasing and multifamily to use AI automation. Here's what we're dealing with, just again, lifting the Komodo a little bit, is that a lot of the traditional property management systems and software, they're not necessarily the quickest to adapt, and sometimes they can be relatively closed off systems, and they were already a little antiquated, but they was kind of fine for a while.
Yeah.
But it's not really fine anymore when new CRMs, new marketing systems are generations ahead of what kind of property management legacy systems can do.
Yeah.
But you're stuck in some of those systems, and so I think there's going to be some major disruptions in the kind of the prop tech space of a lot of new entrants. And then, for us, we're looking outside of kind of property technology and just looking at what's the best software and how can we adapt it to multifamily. It doesn't necessarily have to be that complicated. You don't have to get something that is absolutely custom built only for leasing multifamily properties.
Right.
Especially on the marketing and leasing side. But yeah, they say that there's going to be a 26% increase in the use of AI generated marketing, where there was from 2024 to 2025. Yeah, I mean, if you're kind of, to be honest, I mean, 2025, a lot of the marketing, you're kind of forced to use AI generated marketing to some degree. I mean,
Right.
if you've built a Google ad, I mean, like, it basically starts by building the whole thing for you, and then you have to go through and say, no, that's not relevant at all. I'm going to fix that. And
This 26%, with the adoption of AI growing so quickly from 25 to 26, I would be very curious to see what that number jumps to.
I was going to say 2026, I guess it's increase of use. I guess I'd have to know what the previous use was, if
Right.
it was already a lot, and what the adoption rate is. But that, yeah, 26% isn't necessarily that much. I guess it is a growth rate rather than like an overall adoption
I
rate.
just feel like from 25 to 26, I mean, my grandma's using ChatGPT now, but in 2024 she wasn't. So, I just feel like this number is probably increasing year over year, and it will continue to do so.
I agree. Yeah, no, my dad,
Yep.
stepmom are using it all the time. A little bit too much. That's a little bit too, but it is great. There are some good things about it. The Thanksgiving was interesting. We'll get into some of the questions we talked about. Okay, the leasing centralization trend will accelerate. This has been a trend for the last couple of years. At NMHC last year, in January of 25, a lot of the conversation was about centralization. A lot of folks have been moving towards it. Everyone has been doing a little bit differently. Centralization can mean a lot of different things to a lot of different organizations and different property management companies. I think there's going to be some more best practices that'll consolidate, through 2026. I think that makes a lot of sense. Again, establishing a centralized leasing office for multiple properties. Check, we've done that. Handling the lease process. Thinking that the application, the screening, lease, key handoff, etc. That's what's going to be happening at the centralized office, and you can do more. And then there's podding, which is essentially kind of sharing resources between several different properties, and kind of having like some specialists kind of oversee an area. And we've done a lot of that as well at Gray Residential over the last couple of years. But a lot of folk, regionally, it's different. I've seen in some areas centralization move much quicker and be pretty standard. But here in the Midwest, it's a little bit slower. We're not the absolute first. We've been working on it for the last couple of years, but we really, in 2025 was the year we really kind of kicked things off and accelerated it. A couple other companies did as well, but some other companies were doing it last year.
It seems interesting. Out on the East Coast, the markets are a little bit more tightly squeezed in regards to just surface area of land. And the Midwest, we start to space out, and you get in the West, and again, you get a little bit more space in between your markets. So, be curious to kind of. You probably would never be able to discover this, but the operators that operate on the East Coast versus folks that are Midwest and out West, who's using that centralized leasing strategy. Maybe the most. I feel like the East Coast would be a lot easier to achieve.
Yeah. Well, but it's a good point and a good topic of, again, what centralization means is different to other different folks.
Right.
Because, centralizing your maintenance facilities or podding of maintenance and facilities, that has more geographic constraints. It's harder if you're out in like the Mountain West and you've got hours of travel time between markets.
Yeah.
That's really challenging to do. If you're in New York, New Jersey, or somewhere much more urban on the East Coast, much more feasible to do. If you've got your pod like in one market, you can do it. But then leasing, other than needing someone to actually give a tour, which can be, you can schedule with if there's somebody on site, the centralized leasing team does all of the initial calls, goes through the screening, goes through the application, can tell them about the property, schedule the tour, and schedule it with someone that's on site. The centralized team they can be anywhere. They don't necessarily need to be in geographic proximity.
Right.
Sometimes it can be handy for them to be in somewhat close proximity. But again, it all depends on what you mean by centralization.
Right. That's a good point.
Concessions. Oh, we didn't cover this one. Transparent pricing will be the new standard. It's, what are all the fees you're charging me? What's utilities? What's my application fee? Tell me about my trash fee. Tell me about my pet fee. Who doesn't want people to know about this? So I think this is going to be true. Now, there's some states that are mandating this. We don't like states to mandate it necessarily. We've been talking a lot about some all-in pricing as well, which seems risky because we're going to include all of your fees. We're not gonna. It's all just wrapped in. You get one number. The con is, again, someone doesn't do their due diligence and they see we're charging $2,000 and the guy across the street's charging, $1,950. It's like, well, the $1,950 is cheaper. It's like, well, no, it's $1,950 plus all these fees. Actually ends up being $1,300 versus the all-in $1,200 right here. Once the market is educated or the prospect is educated, they're like, we love it. It's all included. This is wonderful, but you have to get them to the point to educate them.
Yeah.
That could be the challenge. The other, I think it's way more of a positive than a negative, but why people might not want to do like all-in pricing or transparent pricing is then people, like, they can't afford it all of a sudden if they know everything, all the costs, which I think they need to know what they're going to be paying for.
Yeah.
But when individuals are screened for an apartment, they're screened for the rent. They're not, when they go through to see if you qualify from an income standpoint, your income versus what the rent. It's not rent plus utilities plus fees. Mm-hmm. What can end up happening is then it's like, yeah, you qualify barely on your rent, but then what you're going to be paying, you can't qualify. You can't afford it. And then all of a sudden you're delinquent, you can't pay your rent, and then you get an eviction, and that is horrible for everybody.
Horrible.
We don't want to. You don't want to evict anybody.
No.
It's expensive. You don't put anybody out on the street. You don't want to ding somebody's credit. Going through an eviction is horrible. It's a horrible outcome. Mm-hmm. So you want to do everything you can to avoid those outcomes. You want to increase your tenant profile, and so by doing that, it's harder to get it in. Your standards are a little bit higher because you're going to run their income versus the actual monthly. The full boat,
right?
You're going to get a tenant base that can actually pay the rent and increase your collections.
You go to a restaurant, you have a dinner, they bring you a tab, you have a total for your food and beverage, they add on some taxes, some fees, and then there's gratuity at the very end. It says total. I think that there's a way to do this in a very tasteful way that you might run into some confusion right away, but especially as we go to market our units on the internet, providing a monthly rental price, but with an all-in price, and then really describing what that all-in price includes.
Yeah.
It could be the best way. But I remember buying my first car, and it came fully loaded with Sirius XM radio. That was when Sirius was like kind of a big deal.
Yeah.
I bought it. You got the 30-day trial, but I didn't know it was a trial, and they want you to pay, let's just call it $120 a year to maintain that Sirius XM.
Yeah, now you're stuck. You're used to it at that point.
Well, and then guess what I didn't do, because I was like, well, I didn't have to pay $120 for this Sirius XM. So now I bought this car because it had Sirius XM radio, but I'm not actually using the Sirius XM radio. So
that's why you bought it originally.
It's similar to this. Well, it was
one
like
of the factors. It was a cool.
All the cars had Sirius XM radio, but I was excited about it. So you rent an apartment, and all of a sudden you're finding out you have all these other associated fees, and again, maybe you can or can't afford it. I think it's a nice transparency of, hey, here's what you're going to be paying for rent, but our all-in price for the month is likely to be this.
Yeah.
And that all-in price can kind of move and shake just depending on, the year, I guess, and similar to rent. But I think it's nice to have some kind of idea of at the end of the month how much money are you actually going to be putting down to live in this unit.
Yeah. I mean, what's the alternative? Is like, let's just trick people into paying one thing, but it's actually more than what they think they're going to be paying.
Right.
What a bad way to start a relationship with a customer.
Right. So my car payment went from, let's just call it $500 to $620. Well, I like the $500 a whole lot better.
Yeah.
But if you would have told me it was $620, I can have XM radio all year, you bet it.
It's all about managing expectations.
Yeah, correct.
100%. Okay, we're going to move through this. Concessions will remain elevated. I think that's going to be the case. Again, we've got a lot of supply that has been delivered. We're still going to have supply that's delivered, and it takes a while for these things to burn off. And then you're going to be renewing folks, and they're going to be renewing without a concession. Maybe you don't want them to move out. You're going to have to probably give them another concession. Again, depending on where the market is, sentiment.
Right.
This could change. Maybe we won't need them anymore, but we're going to, until things turn around, we're going to see more concessions. 2/3 of renters say they would be enticed by discounted rent.
Who answers no to that?
Who answers no? Someone who is saying, no, I don't like taking surveys.
Right.
Discount rent for 12 months. Everybody likes that. If you rent for 1 month, people still like that. It's amazing the drop off in anything other than cheaper rent. Prepaid gift card that can be used anywhere. Like,
Right.
it was popular for a while, like $1,000 gift card, $1,000 Amazon card. And honestly, the industry was like, that's the best. Like, oh my, we're giving away $1,000 Amazon cards. Because for some reason, saying $1,000, it's almost like cash, go spend on Amazon.
Yeah.
That seems really exciting, but they really want the money. They want it off rent. They don't want to buy like a toaster or something. They don't want to pay in rent.
They just want a deal.
Yeah,
They just want to be cut a deal. They want to feel like they're getting a better deal than what
they're
they
not
would get
here for the
otherwise.
complimentary iPad. They're not here for that. They're not here for the gym. They're not here for any of that. They're here for. I'm here to rent an apartment, and if you can make me a deal on the apartment.
Right.
So that's something to really keep in mind, because the reason why some people do a gift card is all of a sudden they can drop that into their marketing line GL.
Right.
So it's not going to show a discount on their rent.
It's also
That's-
interesting that the 5% variance between the 12 months versus 1 month. If I take your 1 month discount and spread it out across those 12 months, 5% more people would be more excited about that, but it might equal the same dollar amount.
Yeah, and I wonder if the discount wasn't as like the total discount wasn't as great over the 12 months, if people would still prefer that.
Right.
But that's a dramatic fall off. It's good to know.
It is.
Resident retention will take an increased importance for properties at the top price point. Absolutely, we just lease up these properties. You want to keep them. There are options. People are going to be hunting for concessions. They had concessions last year. Are there still some in the market? People have been pretty defensive this year. They're going to be continuing to be defensive next year. Makes a lot of sense. It says vacancy will remain high even as new supply drops. Tend to agree.
I think this just shows the power of resident retention. Just making sure that the folks that are already in your units remain in your units.
Yeah. Especially when you're getting some decent rent growth on those renewals.
Right.
And maybe you're not going to have the pricing power to continue to push those renewals. But, not having to turn a unit that's huge savings. It's not necessarily cheap to turn a unit.
Right.
And to have, add in the time it takes, the downtime versus the materials, the labor, taking up time. Rather just renew you. Okay, 9. High-end properties will explore unique amenities to stand out. Absolutely true. We've had part of our business plans adding some, unique amenities or more amenities. Let's see what some of the unique amenities they're talking about. On-site cafe. Our coffee stations are always so popular. Residents love coming in and getting some free coffee. Now, I don't know if they're talking about a cafe as in actually you're going to pay for the coffee, or
Right.
if it's just really fancy. But we've been working on a coffee program to really have it curated, and in 2026 we're gonna have really, really good coffee at all of our properties. Not just it's we've inherited a lot of coffee machines and stuff like that. We're gonna have really good coffee.
That sounds awesome. I'm looking at these amenities here, and we're down in Miami, as you mentioned previously in the episode, staying at a hotel that offered a lot of these amenities. And it was a very pleasant hotel to stay in. I'm just taking a look at these, and if somebody was going to, it's just almost buying one of the residences at this hotel that we're staying at. You're getting all of these amazing amenities: the sauna, the plunge pool, this recording studio, fitness space, meditation room. These are all things that who wouldn't want access to these? I guess is what I'm saying. It seems like we're creating these dream communities at a price point that is relatively amazingly affordable in regards to buying and owning a home.
The question that I always ask is, what moves the needle? What do people actually care about? And then there's the things that are good leasing tools,
Right.
but then no one actually uses.
Right.
And that's okay, but in a more ideal world, you'd have an amenity that gets people to sign the lease, but then they actually use, and it has some like good utility to the property. The one thing that, and I'm all about it in my own life, is the the cold plunge, the plunge pool. Maybe if it's like physically kind of built in, but I don't know about what the maintenance is on the plunge pool, like who's cleaning the cold plunge, depending on what kind you're or are you buying how expensive of like a cold plunge pool are you buying? How long is that going to be in working order? That's how many people are actually going to be using the cold plunge. Sauna, I think sauna is not necessarily new. I mean, we own multiple properties that have saunas. It was really popular to do in the 80s. Now you can get an infrared sauna much cheaper. When they break, it's something else to fix. Ongoing costs. But I mean, I love the sauna. And they're becoming, I think, more popular with folks. Same thing with the cold plunge.
A lot of these, to me, and especially just in the markets that we operate in, Spencer, where if you go down to Dallas or we're in Miami, some of these are these A-class assets that maybe these are the expectations. In Indianapolis and Columbus, these are not amenities that we commonly find in the Midwest markets. But I'm thinking in more of a strategic manner here. You see a lot of these mixed-use developments with multifamily, atop the, the retail, and there's all of these, health clubs, saunas, cold plunges, yoga studios, cafes down below. There's got to be a way, in our markets to develop partnerships with some of these, let's just call them fitness gyms, sauna studios, to where if you sign a lease at X asset, you've got a discounted membership at the sauna studio across the street. And or you get 2 uses each week. Something like that, where there's some kind of partnership that increases overall marketing capacity at the asset, but also might drive revenue to the sauna.
Yeah, good point. We do have like a podcast room in one of our down in Echo Park in Bloomington.
We do.
Meditation room or pod. Can you meditate in your room? I know what they mean, but the VR room. I mean,
it seems a little
again like. I didn't know you needed a special room unless you got like real fancy setup, all the sensors and everything. Okay, moving on. Low and mid-price properties will maintain high resident retention. Agreed. If it's affordable, I mean, everybody's affordability, it's an issue. People are looking for a deal. If your rents are low, no duh.
Right.
11, unit-specific media will be a must-have. We have found this absolutely to be the point. We have put so much effort in getting videos of every single unit, every single property, so you can actually see that specific unit. No one wants to see a general just floor. I mean, you want to have like a map of a floor plan as part of your materials, because it's nice to see in that way, but then it's like, show me it, give me a tour, whether I want to see that unit. I don't want to just see a model of a different floor plan. I want to see my unit. I want to see if the cabinets are all banged up or not.
It's the next best thing from being boots on the ground in the unit, taking a tour. And a lot of these, whether it's a family or an individual that's moving from market to market, it allows them to, it increases their chances of signing a lease from far away as opposed to just moving down the street.
Exactly. Okay. Well, that's all for the apartment list piece. Let's pivot for the last part of the podcast to talking about recent trip down to Miami, where we spent a whole day meeting with investors, other GPs, sponsors of all kinds of different kind of private alternative investments. So these are, on the GP side, other real estate folks, not just multifamily, but maybe it's cold storage, maybe it's self-storage, maybe it's data centers, healthcare, all kinds of different real estate. But then there's also private equity, people buying HVAC companies, people buying, medical practices, all kinds of different companies. And there's the VC investors who are buying these early stage companies, folks that are on the allocator side, or the GPs that are buying like secondaries or GP stakes, which are really interesting. Folks that are doing private credit, to corporate credit, real estate credit, preferred equity, folks that are lending to cannabis companies, all kinds of interesting
tokenized
things.
Secondary markets.
Exactly. Really interesting. Some of it's esoteric, some of it's right down the middle, some of it is plain vanilla, and all in between. And then on the allocator side, I mean, you have family offices of every different stripe, from the multi-billion, you've heard, you've seen their names in the headlines, to who the heck are you? To a lot of, somebody's kid or nephew from the family office is sent to just learn about investing in general. And, they're kind of they don't kind of fit in necessarily because they're not like as professional as everybody else, but they don't really care. They're not trying to, sell anybody on anything. They're just there. But you've got, private equity institutional allocators, pension funds, endowments, sophisticated family offices, just JV investors, and then just single family offices, folks that they're the guy, and they've had a huge sale. Their family's had a huge sale of a business. Now they've got $1 billion or several $1 billion, and they're doing different things, and they're trying to find opportunities or see what's going on. I started going to these types of events really a lot back in 2019 before the pandemic. I've told you the story, Griffin. I've spent a whole year where I went to a couple of these every single month. And I learned so much about kind of the institutional investing world, how to sort of talk, or at least learn the jargon and kind of just how that world worked. Because, I'm from Indiana, I didn't necessarily, work on Wall Street for a decade or at all. I spent some time on Wall Street, but not exactly in the same way that most folks would think. And so I learned a lot. I didn't necessarily raise a lot of money during 2019, so I didn't have really ton of deals to sell, and I was really just trying to learn. I was trying to make contacts. Then COVID happened. I didn't go to these conferences during COVID because they all canceled. They went virtual. And then I started going to them again. I was going to kind of one of the conferences for a while, but we've kind of gotten back into diversifying a little bit the different types of events that we go to. Just curious, you've been to a handful now over the last year and a half, 2 years.
Yeah.
What do you think the first time you went, and then what's it like now that you're not a newbie anymore? It's not your first rodeo, this last one.
Right. What a collection of people, what a collection of minds, and then more so a collection of how to put money to work. And I think when you go to these conference rooms and hotels and you're milling about the room and you're looking for, essentially that needle in a haystack, and, maybe you've seen the guest list so you know who's there, it's out there. And so there's this kind of hunger to find that person, but you do have to navigate all of these conversations to finally get to, the allocator, the family office, somebody that has a general interest in what Great Capital is doing. But along the way, that journey to find that person and that group, I've had so many interesting discussions. And like you said just a minute ago, it's an incredible opportunity to learn about the different asset classes, about different ways that institutions, RIAs, family offices, high net worth individuals are all putting their money to work. And so in my process of being a part of these, large private markets, real estate, investment conferences, the most enjoyment that I've had is obviously making that connection, explaining to them, who we are, Great Capital, Indianapolis, Midwest multifamily, having them, kind of light up with, oh man, I've been waiting to meet you, but also having that same experience. And then once you have that really positive conversation, and when you get back to the office and everybody wants to know how the trip down to Miami was, it's really awesome to be able to deliver some positive news and just say, hey, I've got 4 or 5 business cards I can't wait to follow up on. But then navigating these conferences can be quite fatiguing. But it is really that those 5 or 6 interactions that you have, that you bring back to Indianapolis, back to Great Capital, that kind of is, illuminates your way and makes it interesting to then go to the next one.
Yeah. Because the one right connection that actually hits could change the trajectory of the business. It could change your individual life.
Right.
If you get in bed with, again, a multi-billionaire who wants to fund every single project,